and what happens if the Fed blinks again. Because the man that's now running the Federal Reserve has already shown his cards. In 1976, the Federal Reserve faced a choice: crush inflation or protect the economy. They blinked. Now, inflation had come down from its 1974 peak. The first oil shock had passed, and the Fed looked at the data and declared the war was basically won, and they eased off. What happened next is the single most important precedent for understanding the gold market right now. Because here's what most people forget. Before the blink, gold crashed from roughly $195 an ounce down to 103, cut nearly in half. The financial press wrote gold's obituary. The bull market was over. The smart money had moved on. And then the market figured out the Fed wasn't actually serious. Over the next 4 years, gold went from 103 to $850 an ounce, an 8x move. And here's the part that breaks everyone's mental model. Bond yields rose the entire time. Rates up, gold up at the same time. Now, gold just fell roughly 24% from its January high that hit almost 5,600 an ounce. And almost everyone is asking what I would say is the wrong question. Is this a correction or is it the end of the bull market? That's not the question. The question is, what is gold actually trading on right now? And what happens if the Fed blinks again? Because the man that's now running the Federal Reserve has already shown his cards. Now stay with me and I'll get to what my point is. So let's start by measuring what just happened. Not with emotion, but with history. From the low in September of 2022 to the peak on January 29th of this year, gold ran about 245% from the low 1600s to a high just under $5,600 an ounce. That is one of the strongest advances in the modern history of the gold market. Now, I'm not celebrating that, but let's measure it, because gold has a personality, and if you study enough cycles, you begin to learn its habits. Habit number 1, big rallies in gold pay a toll. Look at the last 2 major bull cycles. October 2008, gold bottoms just under $700. 3 years later, September 2011, and it peaks near almost 1900. That's about 170%. And what followed? A grinding, soul-testing decline of roughly 37% that didn't fully bottom until 2018. The rally took 3 years. The hangover took 7. Next cycle, 2018 low, gold climbs about 74% into the August of 2020 high, around 2,070 an ounce. Then we saw a 22% decline into September of 2022, which was the launch pad for the run that we just lived through. So here are gold's 2 laws, written in 50 years of price history. 1, the bigger the rally, the bigger the correction that follows. 2, the rallies are fast and the digestion is slow. Gold takes the elevator up, but then it spends some time in the lobby after the initial decline. Now, you apply those 2 laws to today, a 245% rally, the biggest of the 3, followed by a 24% pullback. By gold's own historical standards, that's not a crash. That is very mild, arguably suspiciously mild. And that's your first clue that something about this cycle could be different. Because here's what should get your attention. That price is holding up while almost every traditional pillar of demand is softening. And let me show you what I mean in the data behind it. The rally from 2022 to 2026 stood on 3 pillars, all pushing in the same direction at the same time. That almost never happens. You had sustained central bank accumulation, massive physical demand out of China and India, and a broad fear trade. Investors hedging inflation, geopolitics, and growing doubts about the dollar's reserve status. Now watch what happened to each one. Numbers here are from the World Gold Council's first quarter data. Pillar 1, central banks. First quarter of 2026, roughly 244 tons purchased. Technically up about 3% year over year, still strong by any historical standard, but look at the shape of the chart. Between mid-2022 and the end of 24, central banks printed 5 separate quarters above 300 tons. Since the start of 2025, purchases have essentially flattened out around the 200-ton level. The sovereign bid, the de-dollarization bid that I've covered before on the channel, it hasn't reversed, but it's not accelerating at the pace that it was. It is normalized. Now, pillar number 2, Eastern physical demand. Chinese jewelry demand down 31% year over year in the first quarter. India down 19%. Global jewelry demand as a whole is down about a quarter. And the reason isn't mysterious. Price rations demand. So at $4,500, $5,000 an ounce, the marginal buyer in Shenzhen or Mumbai, they tend to step back. And India went further. The government actually raised import taxes to, I believe, like 15% on gold to basically discourage its own citizens from buying it. So think about that for a second. The government taxing its people for trying to opt out of paper money. Now, file that one away. It tells you everything about which direction the pressure runs. And pillar number 3, the fear trade in its financialized form. Gold ETF inflows in the first quarter, 62 tons. That's down 73% from a year earlier. Add it all up, and total global gold demand fell about 9% year over year to just under 1,200 tons. So now hold these two facts in your head at the same time. Every traditional demand pillar cooling, and the price down 24% from the all-time high, but still sitting far above any historical trend line, still more than double where it traded 3 years ago. If physical demand were the driver, that math wouldn't work, which means physical demand is not what's driving the tape right now. Something else took the wheel. And it's the same thing that took the wheel in February of 2022. So think back to early 2022. Russia invades Ukraine. Gold does exactly what the textbooks say it should do. It catches a powerful, safe haven bid, war, uncertainty, and sanctions on a major power's reserves, and gold rips. And then April comes, and the Federal Reserve launches the most aggressive tightening campaign in 40 years, and the gold rally doesn't just stall, it reverses and bleeds for roughly 5 months. But here's the nuance that matters, and it's a theme regular viewers will recognize. It was the paper bid that died. Futures, funds, financial flows, the leveraged Western money ran for the exits. Physical buyers, they kept accumulating metal the entire way down. The paper market sold while the metal quietly moved into the strong hands. Now that should sound familiar because the same dynamic is unfolding right now. Markets have spent the last several weeks pricing in a Federal Reserve that stays tighter or higher for longer than anyone expected coming into the year. And gold's pullback since January maps almost perfectly onto that repricing, not onto the demand data, onto rate expectations. Now, if you want proof that gold is trading on policy and not fear, watch how it's behaving against oil. What you'll see is when tensions between the United States and Iran flare and oil spikes, gold has been struggling. When diplomatic hopes push oil lower, gold recovers. So read that again, because it should sound completely backwards. So here's what it looks like is happening. Higher oil means higher inflation risk. Higher inflation risk means the Fed is less likely to cut and might even tighten. And gold pays you no yield, so its single biggest input is the opportunity cost of holding it, which is set in Washington. Right now, gold isn't trading the war, it's trading the war's interest rate consequences. That's the entire short-term gold market in one sentence. Gold has gone back to being a barometer of monetary policy, not jewelry demand, not ETF flows, but the Fed. And right now, that barometer is pricing in a Fed that follows through on the hawkish talk. But what happens if the Fed doesn't? What if, like 1976, the follow-through never comes? That's not a hypothetical. There's 2 very specific reasons that I believe that the flinch may be real. And one of them was said out loud by Warsh under oath in the Senate confirmation hearing. So reason number 1, the Fed may not be able to follow through. It's basic arithmetic. The United States is running wartime-sized deficits in peacetime. Now, not exactly peacetime, but it's not an all-out global war. With gross federal debt north of $39 trillion and annual interest costs that have blown past $1 trillion, which is more than our entire defense budget. Now, every point of additional tightening doesn't just slow the economy, it detonates inside the Treasury's own financing math. This is the world of fiscal dominance, the Treasury actively managing its issuance toward short-term bills to suppress long-end yields. When the fiscal authority is steering the bond market, the central bank's independence no longer exists. Fed facing a 1980-style inflation could hike like Volcker because debt to GDP was around 30%. Today, it's over 120. Volcker had room, this Fed has a ceiling, and markets pricing in maximum hawkishness are pricing in a Fed with options that it may not actually have. Now, reason number 2, and this is the one almost nobody is connecting to gold. The Fed just changed how it keeps score, or at least they're talking about it. Kevin Warsh, the new chairman of the Federal Reserve, at his confirmation hearing this spring, told the Senate the Fed's standard inflation gauge, core PCE, was, in his words, a rough guess. His stated preference, trimmed mean measures, specifically things like the Dallas Fed's trimmed mean PCE. Now, why does this matter? Look at the spread. Core PCE, the measure the Fed has used for years, is running at 3.3%, its fastest pace since 2023. Just today, CPI numbers released 4.2 year over year. Core 2.9. Several Fed officials are openly calling that trend a move in the wrong direction. But the Dallas trimmed mean, 2.3. Practically at target. Same economy, same prices, two different scoreboards. And the new chairman has publicly stated that he prefers the one that says the game is almost won. So here's how the trim mean works and why skeptics are nervous. It ranks every price change in the economy and lops off the extremes, roughly the top 31% and the bottom 24. More than half the basket gone. The idea is to filter noise and to find an underlying trend. So reasonable in theory, but economists, including researchers at the Dallas Fed itself, have pointed out that in today's environment, tariffs lifting prices across the broad swath of goods, the trim is cutting out the real inflation, not noise. And this exact gauge gave a false all clear once before during the post-pandemic surge. It suggested inflation would cool far faster than it did. So now put the two together. Fiscal situation that makes aggressive tightening close to mathematically impossible, and a brand new Fed chair who campaigned on lower rates and has already pre-selected the inflation measure that justifies them. Now, I'm not telling you that the Fed will 100% blink. I'm saying that it's definitely an option, and the market is pricing it at close to zero. That is 1976. Inflation looks contained on the chosen scoreboard. The Fed eases into it, and for a while, nothing happens until the bond market calls its bluff. Yields start rising, not because the economy is strong, but because lenders stop trusting the referee. And in that world, the textbook correlation flips. Rising yields stop being gold's enemy and become its confirmation. Both of them shouting the same thing. Nobody believes that the inflation fight is real. Yields up, gold up, together. It's happened before. The only ingredient required is a Fed that talks tough and folds. And we now have a chairman who has very politely already shown us his cards. So let me give you the bottom line in 3 sentences. 1, by gold's own 50-year historical standard, this correction is shallow, and shallow corrections after record rallies tell you that the structural bid never left the building. 2, in the short term, stop watching jewelry demand, ETF flows. Gold is a Fed barometer again. Watch oil, watch the inflation prints. Both are scoreboards, and watch rate expectations. That is the tape. Number 3, the long-term question was never whether the Fed tightens. It's whether anyone still believes them when they say they will. Gold is how the market votes on that question. And one last thought. When the case for gold as a monetary asset was first being made online, it was a fringe conversation. A handful of newsletters, a few stubborn analysts pointing at a central bank buying nobody else cared about. Today, it's on every terminal, in every allocation meeting. The fundamentals didn't change, awareness did. And that's exactly what the early innings of a monetary regime shift look like. First, they ignore it, then it's consensus, and then they ask why nobody warned them. So consider yourself warned, or more importantly, educated, because that's what we do here. So here's my question for you. Does the Fed follow through, or is this 1976 all over again? Drop your answer in the comments. I'll read and answer all of them. And if this kind of first principles breakdown is valuable to you, hit the like button, subscribe to the channel, and follow us on all of our social media. We'll see you next time.